appreciate or gain in value will pay us frequently, like annually, through dividend or interest payment. Why? Because we want to make an investment today that gives us a guarantee of revenue or income in the future that we are not sure about. And so when we do invest, this is just a quick recap of what we did last time. We are investing because we'd like to grow our wealth. Would like to gain through dividend or interest, that is the passive income or rental income, if it is real estate. We are looking at the time gap, maybe looking into retirement. We don't want to put everything into one basket. We want to diversify, we want to divest, and so manage the risk. And that is why we diversify our portfolio. We want to grow our wealth or financial growth. It's much better to invest than just to save. We want to beat inflation. There are tax incentives or advantages when we invest. And ultimately, we want to enhance our quality of living or our quality of life. So one way or another, some of the things that influence our reason to think about investments or investment opportunities could be what we are looking at here. So at the end of the next 45 minutes, just four things I'd like us to go with is to understand what are these asset classes that we can buy into. Generally, there are 5. We are going to look at them. I'd like us to also understand at a high level the risk-return trade-off, high risk, high return, low risk, low return, the investment options that are available, the earning life cycle, and then what next from this point. So if we can at least have a grasp of these 4 things, I'll be happy at the end of it all. So having said that, I'll go to the first item, which is normally when we earn income, we earn money, we earn salary, we earn dividends, profits, or interest. Money that comes in to our basket can be divided into 3 main baskets. That is, number 1, the security basket. This is the basic needs, food or bread on the table. We have life-enhancing basket. This is beyond the basic need. That is enhanced quality of life. And then we have the aspirational basket, that is things to do with self-actualization, attaining our purpose in life, and giving back to community. So from the very basic bottom of the pyramid is about security. When we cover our security, our basic needs, we go up a bit, we enhance life. That is life-enhancing basket. And then up at the apex is the aspirational basket. So what we have is, once we earn income or salary, or whichever way we are able to earn, money comes and feeds into any of these 3 baskets. You are either covering your basics, or you are enhancing your life, you are going on holiday, number 2, or you have achieved beyond yourself. Now you are looking at society, community, or the world at large. One most important thing that we need to understand is what we call asset allocation. When we earn the money that we've earned, it's going to trickle down into these 3 different baskets. What we do is we allocate the money to where it should go. That is asset allocation. Diversification is a subset of asset allocation. It's a common investment strategy that entails buying different types of investment to enable us to reduce the risk of the market volatility. It's what is called asset allocation, meaning that how much of a portfolio are we investing in the different asset classes. Then we have something called trade-off. These are the two key things I'd like us to get from here, is that when we allocate our money into different classes of assets, we will never fully appreciate or capture the massive gain of one asset. Because of the diversification, you'll find that you are only capturing maybe 60% of one asset, 20% of another asset, 10% of another asset. But the net effect is that diversification gives us steady performance and smoother returns, not extremes, extreme up or extreme down. So in general, we have 5 asset classes. Number 1 being cash or near cash assets. Number 2 being equities. Number 3 being fixed income investments. Number 4 being real estate, could be residential, commercial, land, or hospitality. And then number 5 is what we understand as alternative investment products, like cryptocurrency, commodities, gold, fashion, art, collectibles fall under alternative investment products. Now, if we remember the 3 baskets, security, life enhancing, and aspirational, you can start seeing where we are with these asset classes. Let's go to the first one, being cash or near cash assets. Is it necessary to hold cash? Normally, it gives the least returns, but yet it is important to still hold some level of cash in the form of savings or SACCO or money in your fixed deposit. Why? Much as the return is low, cash can act as a buffer, especially for volatility. And here we're saying there could be unexpected expenses that come without plan, so your cash comes in handy. It could also act as dry gunpowder to invest during opportune time. There could be an opportunity for an investment that is almost at a throwaway price. If you have cash, then you could benefit by getting the advantage of purchasing or investing. Unlike if you had that money or wealth in the form of an asset that is not liquid. So at the very basic level, which is what we looked at, the security basket, we need at a personal level to hold some amount of cash or near cash, that is what we call cash equivalent, either in a savings account, in a SACCO, that you can fall back to during unexpected expenses, or not just expenses, it can be an opportunity for you to invest because you have that cash, or you can convert that asset quickly into cash. So generally, people talk about 6 months of your monthly expenditure to be held in cash or near cash. So do you have access to about 6 months worth of your expenses in either cash, in a bank, cash, in an asset that is quickly convertible into cash? So this is not so much into what return you are getting, but it is just for protection, to act as security, or the dry gunpowder that you use to invest in an opportunity that could come your way. The second asset class we have is equities. Equities, normally what we call shares. Where do we get this? From the securities exchange or the stock market. Stocks or equities, they allow us as investors to own a piece of a company that you are not involved day-to-day running affairs of that company or business. Stocks, on one hand, offer the highest long-term gain. However, they are also the most volatile, especially in a cooling economy or saturated economy. So historically, data shows that stocks have proven to be the highest growth asset class, beating all the other asset classes, be it real estate or any other asset class. However, the most important thing to understand about stocks or shares is that this is a long-term game. In other words, we do not expect to access the shares or the income from shares for our day-to-day living. Shares make meaning when we invest in them in the long term. Let me just give an example. For example, the Nairobi Securities Exchange, this is what happened last year. Last year is 2024. According to the Morgan Stanley Capital International Index, MSCI, it showed that the NSE outperformed the 10 major Africa stock markets with a stellar performance of 45% return for the year. Starting at 553 points in January 2024, the index closed at 802 points by September. And that was the best performance in Africa. Market capitalization at the NSE also rose by 30% in 2024, the backdrop of investor confidence and corporate profitability. Let's look at some of the key stocks in the market. We have KCB. If you had invested 1 million in KCB last year in January, you would have closed the year at 1.58 million. KenGen delivered 45% returns. EABL, for those who invest there, 36%, fueled by increased consumer demand. But now, on the flip side, this is the performance of 2024. In 2025, the same KCB, which grew by 58%, may grow by 8% or 5%. So you cannot tell. The same KenGen that grew by 45% may grow negative. That is, go down than where it started during the year. But that's why we say in the stock market, or rather the equities, we are not looking at monthly return or quarterly return or annual return. It is the return over a long period of time. As we shared during the last month's presentation, we saw that it took, that is Warren Buffett, almost 27 years to start making real return. So some of the reason why the stock market performed very well last year and outperforming other markets in the African market, you remember we had an appreciation of the Kenya shilling. I think January, February, we're at around 160 shilling to the dollar. We closed the year at 129.37. So that's one factor. Favorable government policies that boosted investor confidence. For example, some tax incentives for stock market participants. I am aware there are some regulatory reforms that are taking place at the NSE. There was robust corporate profitability across many companies that are listed at the stock market, especially banking and energy. And if you remember, I think the third week of May last year, Kenya repaid the Eurobond debt. And that act alone made the shilling sort of stabilize, and it increased the confidence from the investors in investing in the NSE market. And so some of these things may not be replicated this year. Remember, this is the same year that we had about 3 months, I think June, July, and part of August of the Gen Z uprising. But against the backdrop of all that, the market still outperformed the rest of the markets in Africa. So when it comes to the stock market, it is impossible almost at an individual level to handpick stocks, to know which stock to buy, and to almost predict. That is why the key thing that we are encouraged when it comes to the stock market is, other than just relying and depending on expert advice, that is from the brokerage houses, is to invest in a sort of an index where you have companies across different sectors. For example, if you are investing, let's say, 500,000 Kenya shillings, you could have maybe 200,000 in one company in banking and finance, maybe 100,000 in a company in the insurance sector, another 100,000 in the energy sector, and maybe another 100,000 in agriculture sector, so that you are not having what we call concentration risk, where if things were to go south, that you'd have too much loss to bear. So you'll not have, you may not enjoy the 58% increase in KCB across your investment portfolio, but you'll have 58% increase maybe in 30% of your portfolio. You'd have 45% increase in another maybe 20% of your portfolio. And you may have a negative, maybe negative 10% decline, but only limited to maybe another 20% of your portfolio. So in the end, at the end of the year, you'd find that you have a net increase, but it's because you have done what we call diversification. Diversification through your asset allocation. So you have that trade-off where you are not fully capturing the startling gains of KCB, but you are also not getting the full loss of another stock that maybe you would have invested in 100%. Okay, so why did okay. So some of the risks that if you today want to invest in the stock market, you should consider and be alive to, regardless of which period, is, for example, currency volatility. You never know where the Kenya shilling would go in the middle of the year, at the end of the year. It could strengthen, it could weaken, again, affected by other microeconomic factors. We have what we call market liquidity. Which stocks are you going to choose And in this case, that's why we are advised that we don't just select stocks that are performing well, select also stocks that have some liquidity in the market. What do we mean by that? What is the volume of trading? You'd see in the business news, they'll say the top gainers, the top losers, and also the trading volumes, the most traded stocks and the least traded stocks. So you may buy stock that is growing so much, but maybe it does not have the liquidity, so that the time you want to exit or liquidate, you have nobody to offload the same stock to. Geopolitical factors, they are also coming in to affect the market, because ordinarily the market, the investors in the stock market, for example, the Nairobi Securities Exchange, close to 77% are foreigners, is FDI, foreign direct investment. So anything that happens maybe in the US, in London, in the Middle East, in across Asia, has a correlation, has an effect in how the market would perform in the NSE, in terms of, will there be appetite for investment or will there be capital flight? So those are the other things that you need to consider that are beyond your control or our control. So in terms of going forward, what do we expect? 2025, the performance for last year in 2024, I don't think we can get to that kind of performance this year, but still the performance may still be good, but maybe not to the level of 2024. And this will be affected by, key among other things, the economic growth in Kenya, fiscal policies. We saw last week or Monday, the finance bill was passed. Again, performance of key sectors, especially in our local market, it is banking, agriculture, and energy. How the individual companies, the ones that are listed in the market, perform will affect the overall NSE performance. We have a global economic environment, the impact of the US foreign policy, Russia, Ukraine, Israel, Iran conflict, how protracted these conflicts would be, and what other macroeconomic factors they are going to affect will also have an impact in the local market. So basically what I wanted us to understand is that when we go to the stockbroker and sign up and give money to invest in the stock market, it is not just the performance of the local company, the KenGen, the Kenya Power, or Safaricom that will matter. That is important, and it is the main driver of the share price or the dividend. But there are other external factors within the economy and global factors that will affect the share price as well as the dividend policy of these companies. And that's why we said from the beginning, investing in shares, or rather the stock market, is a long-term process. We are looking at a long-term horizon, so that we are not focusing on the day-to-day activities or outcomes. Otherwise, it may distract us from the long-term opportunity that the market presents. Because what happens is that as we have, or as we gain the capital gain, as well as the dividend growth, this over time tends to do what we call compounding, in that a share that is growing at maybe an average, we're looking at the composite index that you would invest in, maybe five companies. If they would grow at a modest, maybe 14% year on year, this kind of a return, if it was to be maintained over a 10-year period of time, it is a kind of a return that you cannot get anywhere else in the market. So that is what we have as an outlook from the market, being our asset class number 2. We started from cash, where we need just to hold just a little for survival, unexpected expenses, and opportunities that would need cash almost on the spot. Then we have the equities. And so how can we invest in the stock market? We can trade by opening an account with a licensed stockbroker, or that is the CDSC. The NSE also offers online trading platform that make it accessible and convenient for individuals. Especially this is for the case of the Kenyans in the diaspora. So the other asset class number 3 is the fixed income securities. Fixed income securities, as the name would suggest, it is fixed. Why? And these are mainly bonds which come and they give a fixed income, and this income is in the form of an interest to the investors who lend money. The bonds can be from government or from a company. I know most of the bonds that have been marketed are from the government, but companies also do issue bonds. For example, I think before it went under, Nakumat had issued some commercial bonds, commercial paper. So bonds are income generators, and because they are fixed, they tend to give a more modest return. It's much lower. And generally, bonds have an inverse relation with stocks. Maybe I can take some 2 minutes to explain this. The relationship between bonds and stocks or shares. For example, if let's go with the first example we saw of KCB. KCB wants to expand to Ethiopia, and they require some maybe 10 billion. They can go to the securities market, the NSE, issue more shares and attract new owners or new shareholders or existing shareholders to buy into those new shares, and they get 10 billion shillings. They go to Ethiopia and enter into that market. Alternatively, they can issue a bond which is a promise of paying you back your money with interest after a certain duration of time and raise that same amount of money. So when the share price is performing well, for most companies, when the share is performing well and the market responds well to the company, companies are incentivized to issue shares to raise money because it's cheaper. However, if the share is not doing so well, they would issue a bond in the market and collect money, but it's a form of a borrowing. And so when the share is doing so well, there is no incentive for borrowing. And so they would issue more shares to raise money. But the inverse is true. So when this happens, bonds are give us what we call almost a surety. However, there is no upside opportunity like for the shares. We've seen in the shares where a company is growing by, the share price is growing by 45%, 58%. When it comes to bonds, it is fixed, but it is almost guaranteed, which takes us again back to our baskets. Our baskets that were telling us about security, life enhancing, and aspirational. If you do not want to risk so much, and if you want your money back within a certain specified time horizon, you are looking at security. And so bonds tend to play around this area of the security basket because you don't want to gamble. You want this money back after 3 years or after 4 years because it's money for school fees. So instead of it lying, earning 0% in the bank, being eaten up by inflation, you can invest in the stock market. There are bonds, the government bonds, they are commercial paper or commercial bonds, which promise you a return after a certain period. And so that is where the fixed income securities come in. They give us modest return, but are usually weaker, especially during an expanding economy. Moving from this third asset class, and for fixed income securities, the main thing is actually just the time duration. After the time duration, you're able to earn your principal back and your interest, less the taxes. We have another asset class, the fourth asset class being real estate. Real estate, especially in Kenya now, when 2010 August, the new constitution came into being, was promulgated, and in 2013 we had the first time we had the counties. So with counties, we have seen an acceleration of urbanization, with more people moving from towns, searching for better job opportunities in the cities for lifestyle and better amenities. As this shift continues, you'd remember, even if you look at maybe where you come from, maybe you have some cousins, some relatives who are just up country, but now when the counties came into being, they moved to the towns, they got the employment, and now they are settling in the towns, the urban centers of those counties. So what has this done? The demand for homes, especially affordable ones, has really skyrocketed. According to government data, this is 2 years ago, about 500,000 housing units are needed on an annual basis to meet this demand. And you can be sure we are nowhere near supplying this kind of numbers on an annual basis. So this is the landscape of real estate in Kenya. Especially if you look at Nairobi, today, if you go through Ngong Road, Kilimani, Parklands, a bit of Westlands, almost all the construction that is coming up is taking the form of joint venture. Joint venture, how? Someone has land, someone has an old building, they partner, maybe 70-30, and they pool resources so that the developer does not have to buy land. And this helps to reduce the risk and cost of entry, especially for those who are new into the market. And this is to address the above gap that we saw, 500,000 housing units on an annual basis. Because on an annual basis, the shift from up country to the cities is continuing. It does not stop. People are coming from former Northeastern Province, Western Province, Nyanza, Rift Valley, from across the country. And that is the opportunity that exists. Now, one of the opportunities that we have at the moment is the KMRC, that is the Kenya Mortgage Refinance Company. This is a government's tool of trying to boost the absorption of affordable housing. This is a mortgage that is available to us. You can go and check with the Kenya Mortgage Refinance Company. But you must be looking for a mortgage or a house that is in the range of between 8 million and maximum 10.5 million. They are giving the loans, the mortgage at 9.5% interest through participating banks. So this is one of the low-hanging fruits. At least we know for this term, for this the current government in place, this one is one of the fiscal policies that is there. So it's a good opportunity to look at and take advantage of, because some of these rates, it's the market rates are much higher than this. The only thing is that it limits the amount that you can borrow between 8 to 10.5 million. Some of the opportunities we are seeing are the outskirts of Nairobi. Places like Kitengela, Matu, Konza, Katani, Ngong, which are transforming into mini cities. By mini cities, we mean they offer everything that you would get in Nairobi CBD or its environment, from hospitals to schools, business parks or business malls. However, the cost of living in these mini cities is a fraction of what you'd get in Nairobi or the outskirts of the CBD. So some of the opportunities we are seeing is in the real estate is what we call demand for gated communities, especially for young families, young professionals. They are willing to pay a slight premium for safety and a better lifestyle, but they may not be able to afford the same one in Muthaiga, but they would want something close to Muthaiga in Katani, in Ngong, in Kitengela. So these are some of the opportunities we have in real estate, but the most important thing in real estate is also rentability. We are seeing people who are looking to invest in real estate, both here and those in the diaspora, but not to live, to invest in, for example, 1-bedrooms, studios, 2-bedroom apartments, And the thing they are looking for is, can I get a tenant to live in that place so that I can get the rental income? Rather than putting my money in money market where maybe I'm not getting as much, can I get the same from real estate? From the aspect of commercial real estate, it has not grown as much, but we are still seeing some demand, especially for go downs along Ruiru, Mombasa Road. We're seeing companies like Jumia, Sendi, Copia. They are setting up warehouses close to urban centers to be like distribution centers, especially around Nairobi, Mombasa, and Kisumu. So that's another area we think would see some growth going forward as the adoption of e-commerce continues to grow. It can only increase the demand for some of these setting up of some of these warehouses. So the key takeaway from real estate is that rapid urbanization across the country, improved infrastructure, and favorable government policies are the key drivers driving the real estate sector. Affordable housing is key, but when it comes to Nairobi, satellite towns have higher growth potential, and there is also an increase in the demand for gated communities. Short-term rentals, that is Airbnb, are currently giving some of the highest return on investment. We are seeing diaspora-driven investments and an increase in what we are calling the mixed-use development. It started, I think, with Two Rivers, where we're seeing investment in residential areas that have malls and shopping malls and banking halls and swimming areas, all under one roof. So this is the kind of trend that is taking place in the market. Now, we've looked at the 4 asset classes. That was cash and near cash. We had equities or shares. We had fixed income securities, which was just bonds. It could be government or corporate bonds. We've looked at real estate. Finally, we have what we call the alternative investment products. This one is like, does not really fall in any of the first 4, but it can be a conglomeration of any of the other 4 again. Alternative investment products is a financial asset class that does not fit in the conventional equity, fixed income, or cash category or real estate. Collective investment schemes, or CIS in Kenya, are governed under the Capital Markets CIS Regulation 2013. When it comes to alternative investment product, we have seen funds that are called special funds, which have come up, that are professionally managed. They pool resources and invest in portfolios that target non-traditional assets. For example, real estate, private equity, venture capital, international markets, and sometimes they even leverage or borrow to enhance their potential to even increase the gains. What I would say is that these special funds, they are attracting what you would call sophisticated investors. Investors who are seeking much higher return, a broader diversification, but who are also able to absorb or have a higher risk appetite. Some of these special funds, they are operationally, they are more flexible compared to the unit trust or money market funds. And they can invest in real estate, commodities, cryptocurrency, collectibles, and even foreign assets. So in Kenya, I'm sure some of us would have heard about some of these funds. We've heard about maybe Mansa X or Oak Special Fund or Lumusho Special Fund. For these special investment funds, number one is entry. You'll see the minimum investment. Actually, for a while, it was $1 million. It's only that Oak Special Fund is now $500,000 and Mansa X is $250,000. But what they do, they are looking to attract sophisticated investors, get a high pool of funds, and then invest in high-risk ventures, but potentially also give a high return to the investors. You can see the minimum investment, the minimum top-up. What they also have, there is a minimum lock-in period. You can't just invest today and next month you want to get out. For all of them, the minimum is 6 months. Others is 9 months, others 12 months. Why? Because they need the time frame for them to invest, attain the growth, and then get the return. They also have slightly higher management fees from 2% all the way up to 6% of the management fee. For Mansa X, there is even a performance fee that whenever they perform at what they promised, which is what we call hurdle rate, they charge an extra fee on the extra return above, over and above what had been promised. But for all of them, you would expect the risk to be high. I mean, risk to be high in terms of what they invest in. But it is because of that they are able to also get a higher return to pay back to the investors. So before I go to the last, as we close, before I go to the last point, I just want us to take a look back at what we shared around the 5 asset classes. Why it is important. We've had people that are called asset rich but cash poor. Is because you have an unforeseen emergency, unforeseen opportunity that has landed on your table, but you are unable to take advantage of that because you don't have cash, you don't have liquid cash, but you have assets in the form of shares, bonds, and real estate. So that's why we're saying it is important to hold some level of cash 3 to 6 months of your monthly expenditure to take care of that. For equities, we've seen that we can never predict. We can never tell which one will perform well, which one will not perform well. So it is prudent for us to invest in equities, but not in one share. The fact that Safaricom is the best company in the region, most profitable, does not mean that you invest all your funds in Safaricom. The fact that maybe KCB or Equity is the most profitable bank does not mean you invest all your eggs in that basket. But can you diversify through what we called asset allocation in at least not just different equities or counters or shares, but also across different sectors? So that if today there is drought or flooding and agriculture is affected in the country, we have famine or drought or floods, and the shares of companies in agriculture affected, it does not wipe out your investment. So that you have at least 3, 4, 5 sectors you've invested in. That is what we call our investment portfolio in equities. Fixed income investment, these are bonds issued by the government, issued by companies. We are certain it's for 2 years, it's for 5 years, it's 7 years, it's 10 years. You have locked this money for that long period of time. You know the interest payment up front, and you know this is money you have put aside for a future utilization, maybe that you are intending to invest in or to spend in a later date to come. Real estate, the high rate of urbanization portends a great opportunity, especially for residential investment. When it comes to the city, the area around, outside the city, that is around Ngong, Katani, Kitengela, those are some of the most promising areas that we are seeing, as well as commercial. This would be the go downs, again, outside the city. Alternative investment products, not just investing in them. This is the time I would urge us to invest also in our knowledge when it comes to alternative investment products. Not just putting money, but also getting knowledge to understand artificial intelligence. How does it affect our work? How does it affect our careers? How does it affect our business? Understand cryptocurrency, understand where the future is going, understand IoT, that is the Internet of Things, understand machine learning, and not just for the sake of investing, but also for understanding where the opportunities lie and where the future promises to go. At the beginning of this century, we had the dot-com bubble. That is the opening up of the web, the internet. Then around 2007, 2010, we had the growth and influence of social media. This time, I think we are looking at the growth and influence and effects of artificial intelligence, IoT, and crypto. So what are the opportunities that exist? What are the challenges, and how will they affect us? Finally, as a rule of thumb, we normally say that investment, you are targeting 25x. And what is 25x, as I conclude, is that you are looking, especially if you are looking forward to invest for retirement, you are looking forward to a place where the return on your investment, the annual ROI of your investment, would be enough to sustain your annual expenses. And so we normally say, take a number today. That number would be your annual expenditure for last year. What were your total living expenses? Leave alone, you are building a house. No, just living expenses. Remember the safety basket. Food, shelter, clothing, the basic. Your annual expenses multiplied by 25. If you take your annual expenses multiplied by 25, that's just a rule of thumb. Give or take. That's the figure you should be having as your value of investment. with that, I'd like to bring it to an end and then invite questions from the floor. Thank you.
Thank you very much, Mr. Ogega. I think that was quite the practical and rich presentation. I think a lot of the information you shared with us here is available out there at a very premium fee. So I do not take that I don't take it for granted that we have this opportunity with you to get quite the rich and practical examples. Members, our chat boxes are open. Please put in your questions in the chat box. Elder, as you respond to the one question that is already there from Elder Olonde, where would you place the rates? Elder Marube, this is for you. I think you're on mute if you're speaking.
Sorry. Yes, go again.
Where would you place REITs? I think that's a question in the chat box.
Real estate investment trust. Huh?
Yeah.
That would be. Let me see if I can share that. Let me see if I can share. Yes, I hope you can see my screen again. So
yes, we can.
REITs are a form of special funds because you invest, as you invest in the REITs, it is professionally managed to build a form of real estate that will either be sold or managed on your behalf by professionals. So you are not buying, maybe if it's a building with 100 units, you are not buying 1 unit or half a unit. You are buying the entire cake. So that would be a special fund, and that is one of the areas where these funds commit or invest the funds in. It would be in what the REITs do. They invest in, real estate that is highly marketable and that is of premium grade, that individual investors or contractors may not manage to pull off, so that you find that they are able to maybe get a very premium place or location or address and put up a very maybe investment, A-grade investment kind of real estate. And they have also maybe the customers way before they even start such kind of investment. So that would be part of what is professionally managed under the alternative investment product.
Okay. So Elder, I have a question for you. I think there's a considerable number of Kenyans, and I think it's a generational thing, who believe that so the moment you start earning, you must buy land, either to speculate or to build. I mean, wealth to some people is measured by how much land you own. What would you say to this? Is that still something that should be considered as an investment?
Yes, that is correct, and that is quite true. Because where I say that is that it's not just buying land, but it's what land are you buying? Again, investment, any investment is informed by what you'd call something like market intelligence. Why are you buying that land? You've said, for example, it's for speculation. Are you aware of maybe the future plans, the future growth trajectory of that area? Do you have the proposed expansion of maybe the road network? Is there the university that is going to come there? Is there, a market that is going to be built around there that is going to inform the increase in value of your land? So land remains, why land remains critical, vital, it's just a form of banking. It's a form of banking that you can unlock in future at, maybe 2x, 3x of what you invested. So it is you are number one, beating inflation, and you are potentially going to gain. But at the end of it, it should be strategic. Whatever land you are looking at should be strategic. Remember, we also talked about liquidity. It shouldn't be in a place where maybe 5 years, 6 years down the line, you'll again struggle to get someone to buy it. So it's good, it's encouraged, but be strategic while at it.
All right. Thank you for that feedback. I think quite informative. Members, I will give a few seconds for anyone who has a question and did not get an opportunity to put it down to maybe raise up their hand and ask. All right, Elder Marube, thank you very much for your time.
I can see from Elder Paul.
Yes.
He's talking about peer pressure in acquisition in property versus affordability for the buyer. Again, very, very practical. Because if I had 1 million shillings today, number one, and I want to buy property, what would I be looking at? We've talked about the potential of an area, but you see, maybe I do not have 3 million to buy where the potential is. I believe there is still somewhere else, a different location, a different place, a different address that is affordable, that can accommodate 1 million and is also has potential. So at the end of the day, it is also good to look at the dynamics at a personal level. Thank you.
Thank you, Elder. I think someone was saying something.
Sorry, I was trying to raise my hand, but I couldn't see. My phone, for some reason, is not behaving. Can you hear me?
No worries. Go ahead. Yes, I can hear you.
I'd like to ask Elder Marube, what advice will you give someone who's young? I got this question from someone who's like starting, and they have like 100,000. They're just 21 and they're starting, and they have 100,000. Which best investment will you advise them to take? Do they buy government bills, or what investment will you suggest for them?
Very well, thank you. And that's a very good but also practical question, because I believe there are many who are in that level, that situation today as we speak. So I would say the best investment at that age, 21, 22, 24, 100,000 shillings, is to invest in themselves. And how can they invest in themselves? It is to learn the ropes. What we have done last month and tonight is just theory. But where the rubber meets the road is the practical aspect of it. So with 100,000, I would probably advise them to commit about 10,000 to good books on investing from a good bookshop. And maybe with 190,000, there may be no land to buy, but take maybe the 80,000 and go and open up the CDS account, buy some stock, play around with it, have some 10,000 shilling in a savings account, and leave the theory part of it. Because when this 100,000 changes into $1 million, they would have prepared themselves psychologically, mentally, practically, in all sense, in what they ought to do. When it goes from 1 million to 10 million, the same thing. So it is to train themselves at a very young age, and that is a very good place to start when you have no money or very little, so that when you grow, your system is aligned. You know what to do.
Thank you very much, Elder. I think that is all the time we have today. I take this opportunity to really appreciate you and your time. May God bless you. May God bless your family. We don't take that for granted, that you've taken your time to share your wealth and your knowledge to the rest of us, so we can all grow together. I would like to now take this opportunity to hand this session back to, or to hand this session to Elder Elisha to maybe close for us.
Thank you very much. I really appreciate Elder Barube for the wonderful presentation. Brother Gondi for choristering and giving us wonderful music at the start. And also Elder James Thumi for leading us during the prayer session. Thank you very much, Valentine, for moderating the session. Next week, we'll be back again with a different thing, and we are going to legal matters. We'll be dealing legal matters and Bill of Rights. So if you have questions regarding the same, we will have some of the great minds that we have in this country, that people that represent, those big cases you've seen in the country. We'll have them for the next 1 month in July, the month of July that is dedicated to legal matters. So if you have any question, if you want to improve yourself with legal knowledge, please queue yourself in and be ready. Join us next week and for the rest of the month. Thank you very much, and let's pray as we close the session. Father, mighty God in heaven, we thank you so much for your goodness upon us. Thank you for this wonderful session that we've had this night. I pray that your blessings may be upon your children, oh God. Thank you for the lessons that we've gathered from our Elder Marube. I pray that this may go a long way in nurturing us and preparing us for investing in ourselves and in the future, so that, Father, we may not be beggars in this world, but behave like children of the King who we are. Be with us as we spend the night. Give us a lovely night. Until we meet again, Father, it is in Jesus' name that I pray.